Indian stock market saw 327 IPOs in 2024. We are not just number one in population, we are now also leading in the world in the number of IPOs. This trend has particularly picked up after the pandemic. Consider this. In financial year 2022, companies raised over 1.1 lakh crore rupees through IPOs. In the last 3 financial years, Indian companies collectively raised over 2 lakh crore rupees through IPOs, more than a 200% jump compared to the pre-COVID years. And this comes at a time when global IPO activity has actually slowed down. China, for instance, saw its lowest IPO listing activity in a decade. And this might just be great news for India. We have continued to be the fastest growing major economy. IPOs are increasingly becoming a great way for companies to raise funds, the funds that they would need for their future growth. Retail investors too have been flocking to IPOs. In the last 4 years, retail investor participation in SME IPOs alone has jumped by a mind-boggling 600 times. In an ideal world scenario, IPOs would have been a great way for investors to participate in the growth of a newly listed company. But in the current scenario, IPOs are increasingly becoming similar to, well, gambling. Grey market premium or GMP and subscription levels are tracked so closely that it would be fair to argue that many people are mostly looking to only make a quick buck. And it's not like people are not making money. If we take a look at these numbers on a median metric, the IPOs that received the highest subscription delivered higher listing gains. Data also shows that almost 50% of individual investors sold their IPO stocks within a week from listing. Big gains, big exits. But is IPO investing as easy as it is made to sound? Let's bust these myths. A supposedly great IPO can also fail. Subscription levels are never a guarantee of listing day success. Let's take a look at these 3 IPOs for example. Davin Sons Retail Limited subscribed almost 121 times. Wow. As per past data, this should have given banger listing gains. But the actual result? A minus 20% listing discount. Note that in this IPO, the retail quota was the most subscribed quota with 164.78 times subscription. Moving on to Deepak Builders and Engineers India, subscribed 41.54 times. Retail subscription 39.79 times and listing gains just a little below zero, minus 1.48%. Another example is Onyx Biotec Limited. Overall subscription 198 times. Retail subscription 118.26 times. Whoa, this one got a lot of interest. But listing gains? Well, a discount of minus 11.39%. I know you are wondering, but how can an oversubscribed IPO list at a discount? The truth is that oversubscription is only an indication. It is never a guarantee. Listing day price of an IPO is determined during a pre-open trading session. Basically, for 45 minutes before the IPO lists, exchanges like NSE and BSE collect orders from investors to judge the current demand for the IPO company's stocks. By the way, this is the reason why you get to know an IPO's listing gain only at 10 a.m., while the usual market opening time is 9:15 a.m. If during the pre-trading session there are way more sell orders than buy orders, it would result in a listing day discount because people are no longer willing to pay the same price for the IPO. But why would people pay much lesser price than what they were willing to pay just 3-4 days ago? If before the listing there is an unexpected news about the company or the hype about the company turns out to be just hype, then the sell orders might just be way more than the buy orders. In fact, in many cases, a company's listing day performance, whether gain or discount, will not reflect its long-term potential. It might largely just be a result of the demand and supply from investors. If an IPO is subscribed by most only for listing gains, it will see significantly higher sell orders even during the pre-trading session. But the important point is that everyone would want to sell for gains, but only very few buyers would probably want to pay the price that the sellers want because everyone is selling. Hence, it either results in much lesser liquidity or people selling their shares at a discount. In some cases, it almost becomes a liquidity trap. Consider this. If you applied for an IPO for short-term listing gains, you would anyways have to sell the shares even at a discounted price because you would not be willing to park your money for a longer duration. Let's say you applied for the IPO of Deepak Builders Limited, an IPO that received 40 times retail subscription. Before applying, you looked at the grey market premium to get a sense of the demand. The company's IPO was to open on 21st October. Now, between 15th October and 20th October, the company's GMP was soaring. You see that the GMP rose from around 11 rupees to 61 rupees on the day of the IPO, supposedly indicating a 30% listing gain. You may think, hey, if I get 1 lakh rupee worth of shares and it gives me a 30% return in one day, well, I am richer by 30,000 rupees, and that does sound great. You're excited and you end up using whatever savings you have to apply for this IPO. Things are going great till the second day of the IPO. Until on the third and the final day of the IPO, the grey market premium drops to 50 rupees. And what happens after the allotment? A drop back to 32 rupees. While this nearly 50% drop in GMP in just 5 days itself can be spooky, the crazier part is that even the fall in GMP still indicated a listing gain of almost 16%. Compare this to the overall markets that give a 14 to 15% return in a decent year. So on 27th October, a day before the listing, you are still hopeful for a 16% listing gain. And then comes the listing day. On 28th October, you see a listing discount of minus 2.22%, a massive shock for the people who invested just so that they can sell on listing day. Note that a lot of this is irrespective of the fundamentals or growth potentials of the underlying company. This is significantly a factor of demand and supply. And because so many people wanted to sell on the listing, hoping for a listing gain, the stock further fell to 160.15 rupees, a 21% fall from the issue price. People sold at whatever price they got. But there's a case that you would say that these are just exceptions. This does not happen to all IPOs. Well, of course, it doesn't. These are some specific cases. But you never know when you might end up becoming a participant in just one such case. If you are investing only on the basis of GMP and listing gains, well, you are likely to just be as confident as anyone else about your chances of getting rich in one day. And let's say you somehow manage to find the lucky oversubscribed IPO that actually delivers big listing gains. There's a problem there too. You would need further luck to actually get an allotment in that IPO. Such an IPO is likely to be oversubscribed at a level that allotments would be rare. Even if you get, say, one lot of an IPO, the investment amount would be around 15,000 rupees, the average amount to buy one lot in an IPO. A fantastic listing of 50% would mean a listing gain of 7,500 rupees, a meager amount compared to the risk and the luck involved. IPO allotments take place through a literal lottery system. The higher the subscription, the less likely you are to get the IPO. The lottery system is computerized to minimize human error, but it is still, well, a lottery. As per a SEBI study, in the time period April 2021 to December 2023, around 2.5 years of time, a retail investor on average received just about 3 IPO allotments. Now, this is despite the fact that 98% of the total investors, around 90 lakh, were retail investors. Compare that to qualified institutional buyers or QIBs who got 8.8 allotments on average. One reason behind this is that for many IPOs, the retail investor quota is smaller than the combined share for qualified institutional buyers and anchor investors. The pie for retail investors gets even smaller in case a loss-making company is going for an IPO. These include many of the new age tech companies. In their case, retail investors can't get more than 10% of the IPO shares. This restriction has been mandated by SEBI to ensure that retail investors are not taking too much unhealthy risk. So you get the gist. There are a lot of factors that determine whether you will get great one-day returns or not. There's also the other picture, the IPOs that did not get much attention initially. Take a look at Sagility India Limited. Subscribed 3.2 times, retail subscription 4.2 times, an IPO that listed at 3.5% premium. But if you take a look at its performance after listing, it has delivered a return of over 60% in around 3 months. Or Sai Life Sciences, subscribed 10.3 times, retail subscription just 1.4 times, but listing gains of 20%. There's also Mankind Pharma, subscribed 15.3 times. Their retail quota wasn't filled fully with just 0.92 times subscription. The IPO delivered a listing gain of 20.37% and is now up over 122% from its issue price. You get the point, right? IPOs are not a lottery and they should not be treated like that either. Many IPOs come with their hype cycles. The biggest IPOs by issue size, for example, were LIC, PTM, Coal India, Reliance Power, General Insurance, ONGC, and SBI Cards. Now, apart from ONGC, none of these have been able to give superior returns. Now, we are not saying that all IPOs are bad. IPOs are a great way for companies to raise money and for investors to participate in the next phase of growth for the newly listed company. But that's probably it. The more we gamify the process, the more complicated it gets. There's another interesting data point. 48% of IPO investors, or around 46 lakh investors, are those who opened their Demat accounts after the pandemic. It shows a striking image. A very large number of new investors that have seen the success of a few IPOs and of their friends who boasted about their listing gains and have tried to jump on the running train. IPOs can be very risky. Investors who make listing gains end up flexing about it on social media the most. But you don't hear about those who lost money in IPOs, mainly because they wouldn't be willing to talk about it. For anyone who thinks that IPOs are a sure-shot way of making quick gains, it might just prove to be the opposite at times. There's also the information gap. For a company that is going public, there is usually much less information for a retail investor to fairly judge the company and its potential growth. Consider this. SEBI's study also showed that 65% of the total issue size of IPOs was for offer for sale, OFS, which means the company's existing shareholders sold their shares during the IPOs. And these are the investors who would know about the company much more than anyone else because the company has so far been privately owned. If a company has a disproportionately big OFS component, say over 70% of its issue size, that would show that only 30% of the IPO money is actually going to go towards its future growth. It is also important to check who is selling their shares in an OFS. Is it the company's promoters, venture capitalists, or angel investors? While existing investors, including venture capital firms, might fairly want to liquidate some of their shareholdings because everyone at some point needs cash, a high OFS component could be a red flag in some cases. You need the company's existing investors to have trust in its immense future potential too. Unless, of course, their intentions are completely different. Now, even from the 30% fresh issue, a company might choose to repay their existing loans, which means even less investment in its future growth, thus potentially also resulting in possibly disappointing stock performance. For many long-term investors, waiting for the IPO to list might be a valid consideration, at least until its next quarterly or annual results. With time, information about the company is likely to become much more readily available, and a lot of new information is also going to get public. Now, even if you decide to invest during an IPO, it will always be a better approach to look at the company's business, financials, and most importantly, valuations, not just the grey market premium or subscription levels. That over a long term is likely to give much less pain than the constant scrutiny of checking volatile numbers with the hope of getting lucky once in a while. That's a wrap, folks. After all that you got to know today, would you change how you invest in IPOs? Let us know in the comments.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.